If money controls the world, why don't they teach us how it truly works? For millennia, societies relied on bartering, a direct exchange of goods and services. However, this system was inefficient, requiring a double coincidence of wants for every transaction. The solution emerged with standardized money, often in the form of precious metals like gold. Gold's inherent value, scarcity, and durability made it a trusted medium of exchange. This trust laid the foundation for early banking, where gold was stored for safekeeping. Over time, banks began lending out a portion of these deposits, a practice known as fractional reserve banking. This process effectively creates new money, as the loan funds re-enter the economy and are redeposited. From simple bartering to complex financial systems, the evolution of money is a testament to human ingenuity and the constant need for trust.
Inflation is the quiet thief of value. A loaf of bread that cost $1 a generation ago might cost $5 today. Why? Because money is not static. It flows, grows, and changes in supply relative to goods and services. Step by step, inflation occurs when the supply of money grows faster than the economy's ability to produce goods. Banks extend loans, central banks inject liquidity, governments spend. All of these expand the money supply. When too much money chases too few goods, prices rise. Inflation silently drains purchasing power, disproportionately affecting those who hold cash or low-interest savings. Debtors, on the other hand, can benefit. Their debts are worth less in real terms. Understanding this is crucial. Money is not merely paper. It is a living system in motion.
Step by step, financial crises are not limited to the West. In 1997, Southeast Asia faced a dramatic collapse. Thailand's baht, over-leveraged and heavily pegged to the dollar, crashed. Investors withdrew capital overnight. Banks failed, companies went bankrupt, and millions lost their livelihoods. This crisis highlighted the risks of globalization. Governments and international institutions intervened with bailouts, IMF programs, and austerity measures. While the system stabilized, ordinary citizens bore the heaviest burden. Step by step, the COVID-19 pandemic tested modern money systems, economies froze, governments issued unprecedented stimulus packages. Central banks slashed rates to near zero and expanded quantitative easing beyond historical levels. This unprecedented response demonstrated both the power and fragility of modern financial systems. Economies recovered faster than in historical recessions, yet the interventions also highlighted inequality. Those with assets gained disproportionately, while wage earners faced inflationary pressure on daily goods. Step by step, modern money is a complex web of flows. Households deposit, borrow, spend. Banks create credit and leverage deposits. Central banks inject liquidity, regulate rates, and stabilize crises. Governments tax and spend, influencing demand. Markets allocate resources and signal risk through pricing. Every single action, buying a coffee, taking a loan, investing in stock, contributes to this enormous, invisible system. Step by step, human behavior drives financial cycles as much as banks or policy. Consider herd behavior. Investors follow trends without analysis. Overconfidence, people underestimate risk and overestimate knowledge. Loss aversion, fear of loss drives poor decisions during downturns. Delayed consequences, short-term focus ignores long-term effects. Understanding money requires mastering not only the mechanics but the psychology, recognizing biases, emotions, and incentives that drive markets. Step by step, central banks have an arsenal of tools. Interest rate manipulation encourages or discourages borrowing. Open market operations, buying, selling securities to adjust liquidity. Quantitative easing, expanding the money supply by purchasing bonds. Reserve requirements, dictating how much banks must hold. Forward guidance, influencing market expectations through communication. These tools can stabilize or destabilize economies, but their effects are rarely uniform. Winners and losers emerge, and inequality can widen if unchecked. Step by step, those with early access to money and credit accumulate wealth faster than those without. Fractional reserve banking, credit creation, and asset appreciation favor those already invested. Inflation, debt cycles, and policy interventions often amplify inequality, making understanding the system crucial not just for profit but for fairness and security. Step by step, Zimbabwe faced catastrophic hyperinflation. Government overprinted money to finance spending, causing the Zimbabwean dollar to collapse. Prices doubled daily. People returned to barter, and foreign currencies became the only reliable medium. The lesson is clear. Monetary discipline matters. Money only works if it maintains trust, scarcity, and stability. Step by step, individuals can take control, diversify assets, stocks, real estate, precious metals, cash alternatives. Understand debt, use it strategically, avoid unproductive loans, plan long-term, account for inflation, taxes, and market cycles. Educate yourself. Financial literacy is the greatest shield. Observe systemic flows, watch credit, policy changes, and global trends. Knowledge transforms uncertainty into opportunity. Those who understand money gain freedom, security, and influence. Step by step, money is neither magic nor mystery. It is an engineered system shaped by trust, policy, human behavior, and technology. It creates growth, wealth, crises, and opportunity. Understanding the mechanics of credit, debt, banking, central policy, alongside human psychology, gives clarity. Knowledge allows informed decisions, protection of wealth, and strategic action. Step by step, ask questions, seek knowledge, understand money, use it wisely to build, invest, and protect. Once you understand money, you understand power. Knowledge is the ultimate wealth. It cannot be taxed, inflated, or stolen.
As World War III intensifies, nations are exhausted, economies have collapsed, and populations are starving. The world stands at a crossroads. Either the war ends through negotiation, or it ends through annihilation. History shows that cornered superpowers consider the unthinkable, nuclear escalation. Once the first nuclear bomb is used, an irreversible chain reaction begins. Tactical nuclear strikes target military bases and supply depots, destroying everything within miles and contaminating infrastructure for decades. This shocks the world, but only accelerates the conflict. Strategic nuclear bombs, far more powerful, target major cities and government headquarters. The destruction is unimaginable. Everything within miles is vaporized, and firestorms consume entire districts. If dozens of nuclear bombs detonate worldwide, cities become uninhabitable radioactive zones and silent graveyards. Millions die immediately, and long-term casualties suffer from radiation sickness and poisoned resources. More than 100 nuclear weapons trigger nuclear winter, blocking sunlight and causing global temperatures to plummet. Worldwide crop failures lead to extreme famine and ecosystems collapse. Modern civilization collapses as power grids, communication lines, and medical systems fail. Governments fragment, law and order breaks down, and humanity is pushed to the brink. The purpose of imagining such a catastrophe is not to cause fear, but to remind us of what we must protect: diplomacy, cooperation, humanity, and peace. Preventing it is the greatest victory.